As of right now, the market is currently closed and SMX Security Matters PLC wrapped up the last trading session on Wednesday, December 24, 2025 at a closing price of $137.70 USD, marking a sharp intraday decline of $10.94, or roughly 7.36%. This follows a half-day session ahead of the Christmas holiday, where the stock showed immense volatility, oscillating between a high of $154 and a low of $130. Most traders looking at the screen right now see a stock that has shed nearly 7.5% in a few hours of holiday-thinned trading and assume it is just another speculative micro-cap bleed-out. But here is what the surface-level charts are not telling you. That $137.70 figure is actually sitting on top of a massive 3,000% gain over the last month. While a 7% drop looks painful, it is essentially a rounding error compared to the parabolic move SMX has made since its November lows near $3. The real story here is not the holiday dip, it is the fact that institutional interest is quietly beginning to treat this as a supply chain infrastructure play rather than just a tech experiment. The expectation from the retail crowd is that this is a pump and dump that has run its course, but the reality is that SMX just secured a $111.5 million equity purchase agreement that fundamentally changes their survival math for 2026. When you look at the recent price action, you have to acknowledge the tension between what investors want, stable linear growth, and what SMX actually provides, which is high convexity volatility. The stock has been a battleground. For months, the narrative was that SMX was headed for a total wipeout, especially after a series of dilutive raises and a 10-for-1 reverse split in late October that failed to catch a bid initially. But then the narrative shifted. In December, we saw a sudden influx of volume, with some sessions seeing over 1 million shares traded, which is massive for a company with such a tight float. This isn't just retail frenzy on a Robinhood account. The sheer size of the recent equity facility suggests that professional money is betting on the physical-to-digital transition becoming a regulatory requirement. The market generally believes that SMX is just another ESG-focused company trying to ride the circular economy trend. We've seen dozens of these fail because they rely on voluntary corporate participation. However, the deeper take, the one that sophisticated players on Interactive Brokers or Fidelity are likely watching, is that SMX is moving from being a nice-to-have sustainability tool to a must-have compliance layer. They aren't just tagging plastic bottles, they're embedding molecular markers into gold, textiles, and lithium. If you can prove the provenance of a material at the molecular level, you aren't just helping the environment, you're solving the multi-billion-dollar problem of counterfeiting and trade sanctions. That is the expectation versus reality gap. The market expects a green tech play. The reality is a forensic security play. If you're using online investing tools like Schwab Intelligent Portfolios or managing a self-investing strategy, you know that the middle of the pack is a dangerous place to be. You want companies that own a unique niche. SMX's technology uses a chemical barcode that is added to raw materials and read by a proprietary sensor. Unlike a QR code or an RFID tag, you can't just peel it off or fake it. It's literally part of the matter. Recently, the company has been aggressively messaging their execution phase. They've moved past the lab results and are now in the industrial proof stage. This is why the stock has been so explosive. When a company with a market cap under $150 million starts signing deals that look like they could scale across the entire plastics industry in Singapore or the gold markets in the Middle East, the valuation models have to be completely rewritten. Let's talk about the institutional activity and the macro pressures. We saw a lot of sell-the-news behavior on the 24th, likely driven by year-end tax loss harvesting, or simply traders squaring up their individual brokerage accounts before the long weekend. But look at the volume. Even on a down day, the volume stayed relatively healthy compared to the dead periods in mid-2025. There is a clear accumulation pattern from those using Fidelity Trading Platform or SoFi Active Investing who are looking for high-risk, high-reward pivots. The recent amendment to their equity purchase agreement with RBW Capital Partners is a double-edged sword. On one hand, it's an extra $5 million in liquidity. On the other, it involves a convertible note with a 20% discount, which usually screams dilution, which is why the stock took a breather. But the removal of the obligation to buy cryptocurrency with the proceeds, provided the stock stays above $10, is a massive signal of confidence. It tells you the company and its backers believe the share price has found a new, higher floor. Comment below how many shares of SMX you currently hold, or if you think this recent 3,000% run is just the beginning of a larger structural shift. Now, if we step back and look at what SMX actually does, it's important to understand the business model. They operate in the specialty business services sector, but that's a boring label for what is essentially a high-tech detective agency for supply chains. Founded by Hagai Alon, the company is headquartered in Dublin but has a global reach. They provide a three-part solution: a marker, a reader, and a digital blockchain-based algorithm. This physical-to-digital link is their moat. If you're a brand like Apple or Tesla and you need to prove your cobalt is ethically sourced, a paper trail isn't enough anymore. You need a molecular trail. That is where SMX comes in. Their recent financials, like the fiscal Q2 report ending June 30, 2025, showed a net loss of $11.82 million and operating expenses up 156%. Those numbers would be terrifying for a mature company, but for a scaling tech platform, they represent the burn required to reach the inflection point. The history of SMX in 2025 has been a roller coaster of binary bets. For most of the year, it was one of the worst performing stocks on the NASDAQ, down over 99% at one point. It faced multiple delinquency notices and was at risk of being delisted. This created a valley of despair that cleared out the weak hands. When the turnaround started in late November, there were no sellers left, which is why the move was so violent. This is a classic example of why investment help or professional Fidelity Wealth Management often cautions against microcaps, but also why they can be the most lucrative part of a Fidelity brokerage or Robinhood investments portfolio if you catch the turn. Looking forward, the future of SMX depends on whether they can convert these industrial proofs into recurring high-margin revenue. The catalyst to watch is the Q1 2026 data. If they can show that the $111 million facility isn't just keeping the lights on, but is being used to integrate into national recycling frameworks like the ones discussed for Spain and France, then the current $137 price point might actually be undervalued. The risk, of course, is the expectations trap. If the market expects a massive revenue beat and SMX only delivers more partnerships, the stock could easily give back half its gains. They are a sensitive stock type, meaning they are highly susceptible to changes in the economic cycle and regulatory shifts. If you're looking at investing sites or using the Robinhood app to track this, you've probably noticed the buy signals from moving averages despite the volatility. The MACD is currently positive, and the long-term average at $78.31 is acting as a massive support level. For those using Fidelity ETFs or SoFi ETFs, you likely won't see much SMX exposure yet because of the market cap, but that's exactly where the opportunity lies for self-investing enthusiasts. You are getting in before the index inclusion and the safe money arrives. To summarize, the story of SMX Security Matters PLC is a textbook example of expectation versus reality. The general market expectation was a total collapse into bankruptcy. The reality was a strategic capital raise and a technical pivot that caught the shorts off guard. The current price of $137.70 reflects a market that is trying to digest a massive monthly run while dealing with the typical end-of-year profit-taking. We've seen a transition from a speculative meme play into a legitimate contender for global supply chain infrastructure. The challenges ahead, dilution, execution, and regulatory adoption, are significant, but the binary risk that the technology wouldn't work at scale has largely been mitigated by recent industrial deployments. Whether you're managing a Fidelity IRAs or just trading Robinhood fractional shares, SMX has proven it is a name you cannot afford to ignore in 2026. The volatility is the price you pay for the potential of a structural shift in how the world tracks truth in materials.